This year's Wealth Summit is all about being well informed so you can navigate some stormy waters ahead. Recently I caught up with one of the speakers, James Ferguson, who told us a few insights about what he thinks could be about to happen.
Because in the textbook, when you pull a particular lever, things flow through the system in a certain way, and in a fairly reliable and predictable way, and that cons people over time, particularly the regulators and the authorities, into thinking that they've got a degree of control. But the trouble is, if a part of the machine becomes broken, and in this instance it was the banks, then the banks, instead of becoming a nice open channel, become a dam. And once the banks become a dam, then there's an awful lot of running around like headless chickens in the head offices of government, because they're trying to work out how on earth they make the things happen in the real economy that would normally require the banks to be the conduit, the transmission mechanism. Okay. And that's really what we have. And because it takes banks a long time to fix themselves after getting into problems like this, it happens surprisingly regularly enough that we have quite a lot of historical data on banking crises. We know that it takes several years for banks to fix themselves. So during this several year period, things are not normal. Now, in actual fact, the reason why the financial markets had suddenly seized up is that the financial market participants had perceived that the banks might in actual fact be insolvent, in the sense that they might have not enough capital to absorb the losses that were perceived to be coming from the next economic downturn. So the central bankers had to have a very sort of quick, their immediate response in the first year or so of the crisis was to flood more and more money into the system. But banks that have a solvency problem, i.e. losses which are bigger than their capital, aren't going to respond well to more liquidity, because the whole point for them is to not lend out anymore, and in fact try and get back some of the loans they'd already made. So they don't need liquidity, they need capital. But the real problem we had at the time was that monetary policy, which usually proved much more efficacious than fiscal policy, the transmission mechanism, as they call it, the sort of channel by which government or the central bank would transmit monetary policy, was through the banks, and the banks were temporarily out of the game. So really what you need is another conduit through which to deliver monetary policy. So if you want to have nice basic mortgage lending still going on, factoring, trade finance for companies, things like that, and the banks were likely to say, well, right now the answer's no, come back in 5-10 years' time, then maybe we had another sort of mechanism that government could have used, like the post office system, for example, possibly the job centre system, but any network they had which could allow people plain vanilla type credit. The problem historically with doing that, because it has been done in the past, Fannie and Freddie, for example, were both responses in America to these temporary close downs of private sector lending, is that they become very hard to kill, and they then later distort what's happening because they become political beasts. Anyway, in the end, we didn't do that. The central bankers decided they could do a proxy version via QE, about which I think we're going to talk more at the Wealth Summit. And so they went down that route. And QE does work from a macro point of view if you're a macro purist, but it has an awful lot of problems further down in the layering of the economy in terms of winners and losers.
If you think you can survive and prosper in this economy without being in the room for the Wealth Summit on the 7th of November, be very careful out there. Today, we're turning our back on capitalism and becoming slaves to debt.